Hey, everybody, this is Jeff Dohrmann. I'm founder and CEO of Institutional Real Estate, Inc., and I'm excited to launch this new series in collaboration with Alliance Global Advisors. So, welcome to what we're calling the NextGen Capital Markets Conversations. This is a series of podcasts that we're going to be doing once a quarter. The podcast itself is designed to explore the strategies and market dynamics that are shaping the future of real asset investing, from private wealth access to product design and platform evolution. And again, each quarter we'll sit down with members of the Alliance team to unpack key issues and share practical takeaways for managers looking to grow and evolve. I should note that Alliance Global Advisors, among other services, advises investment managers on how to go about entering the private wealth advisory markets, from helping them decide which channels to access to what kinds of products to structure, or how to organize their capital fundraising teams, as well as helping them understand what to expect as they pursue these increasingly mission-critical initiatives. Here at Institutional Real Estate Inc., we publish Real Asset Advisor, a monthly magazine published 11 times a year that's edited to meet the information needs of members of the private wealth advisory community. To the best of our knowledge, it's the only publication that offers advisors the objective, independent, credible information on investing in the real asset classes they've told us they really want and need, filling a mission-critical gap in the marketplace. Our controlled circulation of more than 50,000 private wealth advisors and 5,000 senior executives who approve new investment programs for those advisors to recommend is underwritten by grants from the investment management firms who sponsor the publication. This program is designed to help these companies establish a stronger brand identity in the market, differentiate their offerings from those of their competitors, and get better connected with the people who are in a position to move the needle on their capital fundraising efforts. Our mission, in short, is to help these companies win the capital fundraising battle in this market by helping them accelerate the relationship building and trust building process. Anyway, enough about that. Joining me today from Alliance Global Advisors is Kurt Edwards, Vice President of Partner Engagement. Kurt works closely with investment managers to help them navigate capital markets, refine their messaging, and position themselves for long-term success, and comes to Alliance after helping UBS Investment Management expand its footprint in the private wealth advisory market. Kurt, before we dive into today's topic, can you start by giving our listeners just a quick overview of Alliance and the work your team does?
Sure. Yeah. Thanks, Jeff. And thanks for having me on. And we're excited to do this podcast with you. So the Alliance Global Advisors is a women-owned consulting firm that partners exclusively with real asset investment managers. We help our clients grow, institutionalize, and compete more effectively for capital. We act as an extension of staff, bringing a perspective that blends market insight with hands-on execution. So the firm, which was founded by Jennifer Stevens and Heather Fernstrom, it was launched in 2020. And we've advised managers representing more than 900 billion in AUM. So we continue to evolve alongside the industry. I'd say especially as investors' expectations shift and new distribution channels like the private wealth channel become more relevant.
So let's start talking a little bit and get deep into it. For institutional real asset managers, real estate, infrastructure, energy, those sorts of things, what's driving the urgency to access private wealth capital today?
Yeah, so
What-
I'd oh, go ahead.
no, that's fine. Go ahead.
Okay. Well, so look, I think private wealth, when you look at it related to the rest of the different distribution channels that you can go to as a fund sponsor, is one of the largest untapped capital pools in private markets. Bain& Company, who is a fantastic organization that does great research on this space, they estimate 140 to 150 trillion around the globe, which is nearly half of all AUM, which including institutional capital. So institutional managers are leaning in because traditional sources are slowing, while the wealth channel, especially high net worth and ultra high net worth investors, is showing demand for diversification, for yield, and for portfolio resilience. And yet, this audience is pretty fragmented. So you think about wirehouse advisors, RIAs, and family offices, each operate pretty differently, with varying expectations, sophistication, and product needs. While ultra high net worth portfolios, I guess you could say, is typically defined as individuals with 30 million or more in investable assets. Um, This segment may already allocate over 20% to alts, while the mass affluent investors are still below 5%. So that creates a massive growth potential if, and this is the big word, if access, education, and structures align.
Yeah, and that's exactly why we created the Real Asset Advisor publication is to help fill that gap a little bit.
Yeah.
So, do you think this trend is being driven more by a pull from advisors and clients or a push from institutional capital becoming harder to raise? Because it is harder to raise today.
Yeah, good point. So, I mean, look, the institutional slowdown does play a role, but the bigger shift is really being driven by advisors and clients who are looking for better tools to build resilient portfolios. According to Cerulli Associates, nearly 80% of advisors see diversification as the top reason to use alternatives, followed by then I'd say volatility management and enhanced return potential. Income is still especially important for wirehouse advisors, where 38% rank it among their top three goals. Real assets check a lot of these boxes, especially when wrapped in evergreen or semi liquid structures. But to win in this space, managers need to tailor their products, messaging, and support to a wealth channel that includes everyone from mass affluent investors to ultra high net worth families across RIAs, wirehouses, and family offices. And clients increasingly expect access to strategies they can't get on their own, which puts added pressure on advisors to deliver something really different.
Can you give us a sense of where the focus is right now across the alternative space for RIA and wirehouse clients? How do real estate and infrastructure compare to areas like, for example, private equity or venture capital or private credit from the advisor's perspective?
Yeah, look, it's a very competitive space on the fund sponsors side. So I don't think it's any secret that private credit is still getting the spotlight in the private wealth channel. It's delivering income in a high rate environment, and the rise of asset-based lending is broadening the opportunity set. But look, according to Hamilton Lane Global Private Wealth Survey, private credit is favored for yield and lower volatility versus public fixed income. And private equity continues to be the most widely held. So allocated by 94% of advisors, with a strong focus on tech and AI, though it tends to be more advanced conversations better suited for ultra high net worth clients, really. For real estate and infrastructure, they don't always play dominant in the headlines, but they do offer what most clients actually care about, which is diversification, inflation protection, and after-tax performance. And I do want to just kind of double click on the after-tax performance topic
Yeah.
because I think that rarely sees some spotlight. And maybe that's because compliance teams get nervous, which I totally understand, but I think it deserves more attention. If taxes and inflation are top concerns for advisors and their clients, which some surveys suggest that they are, then real estate should be at the top of that list. It brings built-in tax efficiency through depreciation pass-throughs and REIT-friendly structures. And we won't even get into the 1031 exchanges and opportunity zone programs. That could be a whole nother podcast with you, Jeff. But if you modeled a portfolio based on after-tax real return outcomes, you'd likely see real estate jump in allocation. Yeah, only 54% of advisors currently allocate to real estate, but that number seems poised to grow as more recognize it's not just what you earn, it's what you keep. Infrastructure is also gaining traction, with 48% of advisors planning to increase allocations in 2025, especially due to the CPI linked cash flows and secular growth themes like the data center and energy transition. Meanwhile, venture has pulled back due to valuation resets, but interest lingers around innovation themes like AI. Though I think the bottom line is that advisors want differentiated exposures and a smoother client experience. And I think real assets can deliver both.
Okay, well, it seems that wirehouses, and I would say not just wirehouses, but also independent broker-dealers and family offices were the predominant way fund sponsors accessed private wealth 10 years ago. But
Mhm.
now there's been more of a focus on the growth in the RIA channel. What's driving that shift?
I think a lot of trends that we see over time, private equity typically is in the background of some of those trends. So I
Hmm.
think this one is really no different. Private equity is playing a major role in reshaping the RIA landscape. As the US private wealth market grows at an 8% annual clip, which is double the pace of institutional capital, PE firms see an opportunity to scale quickly through consolidation. With over 16,000 RIAs and many aging founders looking for succession solutions, it's a fragmented but fertile space. Consolidators like Hightower Creative Planning are not just acquiring firms, they're centralizing investment infrastructure, often adding curated alternative products to elevate enterprise value. These offerings have become table stakes for RIAs trying to stand out, attract high net worth clients, and boost margins. And with their reoccurring revenue and healthy profitability, RIAs are attractive platforms for PE. Now, for fund sponsors, the shift means that distribution is increasingly controlled by a few scaled players, changing the access point from individual advisors to centralized investment committees, but also raising the bar for education, support, and platform fit.
Okay, let's assume that I'm an investment manager. What foundational elements need to be in place before institutional managers pursue the private wealth channel? And how would you approach this space with limited resources or as an emerging manager with less than, say, 3 billion in AUM? Or should you even try?
Yeah, great question. We get that question a lot at Alliance. We work with, as we mentioned before, firms that are considered emerging all the way up to the multi-billion global PE brand type of firms. And I'll say many of the clients that are in a small, mid-size, they're really focused in the C-suite is focused in on this topic. So what we typically advise them on is to say, first, you need a dedicated distribution strategy. That includes a team that understands how to work with wirehouses, RIAs, independent broker-dealers, and family offices. Second, operational readiness. So evergreen funds, tender offer structures, and advisor-friendly tax reporting. So thinking 1099s, not K1s. There's a significant resource needed to provide valuations, even often daily, and then also reporting. So ensuring the digital end-to-end workflow is maintained. I mean, all of these activities are pretty big endeavors, Jeff. So it's not taken lightly. But then thirdly, we say a real commitment to advisor education and servicing is needed. This isn't just a build it and they will come market, it's high touch, which means you'll need boots on the ground to interface frequently with wholesalers and advisors. So for emerging managers with limited resources or under 3 billion in AUM, I'd say focus matters. What we typically try to say is start with one channel, often RIAs or an independent broker dealer channel, where relationship building and differentiated storytelling can go further. Partner with a digital end-to-end workflow provider. And you might have mentioned the names before, and I think a lot of people know them. It's Case and iCapital. But what I want to impress on most people is that it's not just those two platforms anymore. So some competing platforms might be better aligned with small to mid-sized fund sponsors. So be laser focused on one or two product structures that fit the needs of your target segment and lead with transparency, performance potential, and service. You won't win on brand scale yet, but you can win on clarity and credibility.
Yeah. So what's the first mistake most managers tend to make when they're looking at this business?
They want a very easy button to push. So they underestimate the complexity, really. Many think that they can repurpose an institutional product and push it through a platform. But private wealth distribution is a business, not a channel. I know we talk about a channel, but it is massive, as you well know, Jeff. And it requires its own strategy, budget, and infrastructure.
Okay, well, you mentioned the importance of being intentional about your private wealth strategy and clearly defining which channel you're targeting and what vehicle structures are actually resonating across those different segments. So what vehicle structures are actually resonating across those different segments, say RIAs versus wirehouses or mass affluent versus ultra high net worth?
Yeah, I think you really structured the question correctly, where the audience that you're trying to go after is often is what dictates the vehicle structure. So I'd say across the private wealth landscape, evergreen funds, whether they're structured as private REITs or limited partnerships, are becoming the go-to vehicle, especially with RIAs and increasingly among wirehouses and private banks. Their appeal lies in accessibility. They have lower minimums, more potential liquidity, and in many cases, 1099 tax reporting. Although, if you structure it that way, that can limit the amount of taxable loss pass-throughs. But I'd say in most cases, investors are fully deployed from day one without intermittent capital calls, which simplifies the experience for both the advisor and the clients. I wouldn't say that that counts out closed-end funds though. So closed-end drawdown funds still do resonate, but mostly with ultra high net worth, family office, and institutional investors who understand and can tolerate the long lockups, capital calls, and K1s. These vehicles allow real estate managers to pursue value add and opportunistic strategies like development, reposition, and distressed asset plays where time, expertise, and flexibility can generate outsized returns. They're particularly useful for targeting sectors like multifamily, industrial, or like niche alternatives where deal level execution matters. But they also carry operational friction and limited liquidity, which makes them a better fit for sophisticated investors who understand the trade-offs. Then you have interval and tender offer funds, which are really the 40 Act structures that sit in the middle. I'd say they're especially helpful for advisors serving high net worth and mass affluent clients who want private market exposure without the full illiquidity of traditional drawdown funds. But when you're catering to the mass affluent, you also have to plan for the operational lift. So these products require much more administrative support, more education, and much bigger marketing approach to gain traction and scale. And last but not least, this is a growing part of the industry that I should mention, which is the appetite for secondaries and co-investments, especially among sophisticated RIAs and ultra high net worth investors. Secondaries offer discounted access and liquidity solutions, while I would say co-investments help reduce fees and boost diversification. They're both increasingly being packaged, if you could believe it or not, inside interval or evergreen wrappers as well, Jeff.
Well, that's a lot of stuff to take in.
Yeah.
What's the key takeaways here?
Well, look, I think vehicle choice is no longer about strategy. It's about matching the structure to audience. Evergreen for access and scale, drawdowns for precision and IRR, interval funds or tender offer funds for everything else in between. For wealth clients, I'd say most interval funds and some evergreen funds allow daily or periodic subscriptions, some liquidity, and avoid ongoing capital calls. So it's a little bit easier for the advisors to work with their clients in a structure like that. That said, they require high levels of active management from the fund sponsor. If you think about it, providing that type of liquidity in an interval fund format, there's a good amount of cash management that you have to do for that. So that's some of the trade-off from like a drawdown fund is that you might not have as high as a return, but you have liquid management, you have constant capital deployment, and robust valuation and reporting infrastructure. Now, again, I don't want to say closed-end funds are a thing of the past. They will always be a tool in the tool set. They still appeal to the ultra high net worth investors and the institutions. And I'd say especially when exposure to vintage year strategies is desired.
Okay, so obviously people can use some help in coming through and sorting through all of that information and coming out with the right kind of strategy for them. How do managers evaluate whether to partner with platforms like iCapital or Case or now SEI, Altigo, or
Hmm.
build their own infrastructure?
Yeah. Well, look, I think this is where, your firm and the efforts that you have in real assets advisors, and then also partnering up with us as Alliance. This is a very complex part of the industry. One very difficult part that we've been talking about is really the facing distribution and the product development. This is now a little bit more on the ops side, and not many people want to go into the COO role and really try to do the brain damage to figure out how this works end to end. So it really depends on scale and ambition. For managers early in their wealth journey, platforms like iCapital, they do offer turnkey access to advisors and back office automation. But larger firms, like some of the larger brand name PE firms, they often invest in their own platform, which can include internal sales, marketing, investor services, and education teams. But many pursue a hybrid strategy, which they look for platform access plus direct advisor engagement.
So you can either make it either or both.
Exactly. Yeah.
Okay. So are platforms a shortcut or a, a longer game than expected?
They're they're a gateway, not a shortcut. Platforms can help scale quickly, but require content, education, and service commitment to convert advisor interest into real meaningful flows.
Okay. And it seems like new digital intermediary platforms are entering the market at a steady pace. What's driving this, and what does that mean to a fund manager seeking to engage with a platform partner?
Yeah, I think you even mentioned some of the names. Many people know the iCapital in case you mentioned SEI, which they now call Access, and that was their acquisition of Altigo, and there's Subscribe. There's a bunch more. But the increase in digital intermediary platforms, it's being driven by, I'd say, two forces. First, the demand from advisors for streamlined access to private markets, and second, the rush by fintech and distribution players to capture a piece of that growth. So, again, back to kind of private equity VC type of capital, you have a lot of that pushing some of the development in this space. These platforms promise efficiency, transparency, and scalable access. So they solve a very big pain point, which is around the subscriptions, reporting, and compliance. I think what really matters here, though, is that not all platforms operate the same way. And that has big implications for both the financial advisors on one end and then the fund managers. Like I'll give you an example. Like Opto Investments offers hands-on RIA native experience. With they really do a good job with deep integration into advisor workflows, white labeled tools, and greater control over messaging. So I'd say it's a more curated consultative model that fits managers looking for tight alignment and differentiated support. Although it may come with slower scale and heavier content needs. I'd say in contrast, you have iCapital, which is built for reach. They offer access to a wide advisor base across wirehouses, RIAs, and private banks. So for managers, onboarding could be more rigid and resource intensive with platform fees and high servicing expectations, but the upside is scalability. I'd say for RIAs, the difference is just as stark. Opto feels like a part of the practice, tech enabled, advisor driven, and embedded. iCapital, while improving, still operates through more of a fund centric workflow. So that means the user experience distinction matters, and advisors juggling multiple clients and client accounts gravitate towards tools that are easy to use and integrated. If it's clunky or too detached, it's not going to work. And so for fund managers now, being on multiple platforms can be a hardship, I'm not going to lie. Heard a good amount of stories on how difficult it is to work across many platforms if you spread yourself too thin. So it does, it fragments advisor relationships. It complicates client account portability, and it can really dilute your messaging if you're a fund sponsor. So the more distributed your platform presence, the harder it becomes to create momentum. Unless you're large, like we know some of the very big brand name PE shops that have their own internal resources and scale actively to support multiple platforms in parallel. But I'd say for most emerging or mid-sized managers, spreading too thin can slow down traction and confuse messaging. That's why managers should be very intentional, choosing partners not just for their reach, but for their alignment and ability to convert attention into meaningful flows. Also, consider multi-platform approach from an advisor's perspective. Client accounts may be harder to move if they're tied to different intermediaries. And operationally, it's more complicated to manage across systems. So managers should be very selective, not just about who distributes a product, but how and where it's positioned for the long-term alignment and scale.
All right. Well, given the complexity, and it certainly is complex,
Yeah.
it seems that hiring a specialist to lead this effort makes a lot of sense. But how else should managers think about the internal transformation required to scale into private wealth? I mean,
Yeah, many
yeah,
times in our client engagements on the alliance side, we're working with all different levels of the firm, but typically starting with capital formation teams. And that means that if they're looking to grow in this space, they need the executive sponsorship, right? So pulling in the C-suite to really understand what resources are going to be needed. So you're talking about product innovation, compliance changes, technology retooling, and a brand refresh even. So the culture must shift from an institutional mindset to a service-driven one, and education has to be embedded. Sales, marketing, ops, and legal. All of those things, Jeff, need to align. So from all of that, you can see it's truly a multi-year transformation.
and a huge change. So
Hmm.
how do you balance servicing institutional expectations while scaling into wealth?
Well, you don't compromise on quality. You try not to as much as you can. The same investment rigor like has to underpin both channels. But the delivery, the communication, and the structure, they may differ, right? So I think we talked about the evergreen funds. They might share deals pari passu with institutional drawdown funds. We've heard Eric Mogiloff, who is a fantastic podcast listen if you ever are able to and search him on the Apple Podcast. He talks about KKR's approach. And that is their approach is they have a private wealth channel and they have an institutional channel, but they're pari passu in the allocation process in the deal pipeline. So that helps to build alignment and it really builds credibility.
Yeah, interesting. So how is Alliance Global Advisors working with managers to help them evaluate whether the private wealth channel is the right strategic move? And if so, how to approach it effectively? How do you
Yeah,
really
well,
work with people?
yeah. Well, thanks for asking, Jeff. So at Alliance Global Advisors, I'd say we're seeing that most effective support is a combination of market education and strategic introspection. So we work closely with our clients, typically real asset investment managers, to assess where their platform and strategic goals align with accessing the private wealth ecosystem. That includes evaluating whether their current offerings align with the expectations of RIAs, wirehouses, and private banks, and helping them really understand the operational, regulatory, marketing, and frankly, I think we really hit on in this podcast, the resources required to compete effectively. So this isn't just about a product. It's about building trust, credibility, and consistent engagement with fragmented advisor audience. So through tailored benchmarking, messaging refinement, and strategy workshops, I'd say that Alliance helps managers define whether they're truly ready to scale. And that could be in the institutional or private wealth space, or if their value proposition needs sharpening first.
Okay. Well, Kurt, this has really been a really valuable conversation, I think, for a lot of people tuning in. Because one of the things that we're hearing all the time from folks, and Brendan Sedloff at Juniper Square brought this to my attention, is even amongst our own sponsors, how many are saying they know they need to be starting to look at this space, but they don't even know where to start.
Mhm.
And so, at least from this conversation, it gives you at least some underpinning of where to start. Before we wrap up, any final thoughts you'd like to share? And for managers who are thinking about entering the private wealth space or just want to learn more, what's the best way for them to connect with you at Alliance?
Yeah. Well, great. Look, I'd just say that this space, it really does reward commitment. So if you're serious about growing through the private wealth channel, which a lot of fund sponsors are now looking into, given the hardship in capital raising in this environment, it's really important to have a clear strategy, the right infrastructure, and the flexibility to evolve with the market. If you want to learn more about how Alliance is helping managers evaluate their options and compete more effectively for capital, look, we'd love to connect. You can visit alliance-globaladvisors.com, or you can reach out to me. I'm very active on LinkedIn or anyone else on our team. We're always happy to have a conversation. So, and I really do appreciate this opportunity to speak in this forum, Jeff.
Well, that's great, Kurt. We really appreciate it. Now, listen, we are going to be providing a briefing on this marketplace prior to our next editorial advisory board meeting for our sponsors, and then open to the public prior to our next VIP conference in January. So if you're, again, interested in learning more about this market, that's a way to get started. I think Alliance is going to be working with us on those programs. And when you're ready, please give Ed O'Farrell, our managing director for our Real Asset Advisor publication, a call. He can explain how we can help you win the capital fundraising battle in this highly competitive but fast-growing market. Thanks, everybody, for tuning in. Next quarter, we'll be visiting again with Alliance Global Advisors to focus on the next topic that we're going to do a deep dive into. Won't be on private markets. It'll be on something else, but we'll be announcing that shortly. So again, thanks for tuning in.